Hello class, welcome to another video lesson on accountancy. Today we are going to take the second unit of your accountancy syllabus, that is accounting for partnership, and under this unit we'll take the first chapter of partnership, which is chapter 2 from your book, which is accounting for partnership basic concepts. Now in this chapter we are going to be familiar with the basic concepts of partnership and the accounting part relating to these basic concepts. So let us start the lesson. So you are familiar with what is partnership. In class 11, while discussing the different forms of business organization, we have discussed that one of the form of business organization is partnership. The other forms were sole proprietorship, then company, then you had Hindu undivided family and cooperative societies, isn't it? Now what is partnership? You're familiar with its definition. Partnership is a relation between two or more persons who have agreed to do some business, and they have also agreed to share its profits and losses. Now to have a proper definition of partnership, Section 4 of Indian Partnership Act 1932, it defines partnership. How? The definition given by this section is partnership is a relation between persons who have agreed to share the profits of a business carried on by all or any one of them acting for all. So the definition is defining partnership, and through the definition we can bring out the different features of partnership. So those who have made the relation between them, those persons will be called as partners, and collectively the agreement that they have entered into is going to form the firm or the partnership firm. And so here the persons who have undergone into an agreement will be the partners, and the business that they have decided to set by the agreement between them will be termed as partnership firm. So from the definition of partnership, we can now tell the nature of partnership. What are the nature of partnership? Now the first nature is it's a relation between two or more persons. So to form a partnership there has to be at least two persons. Just a single person cannot be forming a partnership, because that will become a sole proprietorship. So there should be at least two persons. To form a partnership it can be more than two persons also, but there's a restriction on the maximum number of partners. The number of maximum partners as per Indian Companies Act. As per Indian Companies Act, a partnership can have a maximum of 50 persons. The maximum limit set by Companies Act 2013 is 50. So it should be between this 2 to 50. Another feature of partnership is that it is an agreement. Here the persons who come together, they enter into an agreement. Now that agreement they have entered into may be in written or in oral. So this agreement will set the relation between the partners, which may be for a particular venture, or maybe for a particular period, or it may be partnership at will. The third feature of partnership is that it should be formed for a business, and the business has to be a lawful business. They may not be setting a business for any activity which is unlawful or which is not permitted by law. So it has to be some business which they have entered the agreement for. Neither they may be the business may not be for any charitable activity, or it may not be it may be in the form of a profession, or it may be in the form of trade or a vocation, but it should not be as a charitable institution. and that will become a different case. That may not be partnership then. Also, the next feature of partnership is that the partners, when they enter into the agreement, they form a mutual agency. That is, every partner is an agent of the firm. Okay. So the business of the partnership will be carried on by all or any one of them acting for all. And this is another feature of partnership. That is, partners are agent as well as principals. That is, each of them is for the firm, and each of them means because of each of them the firm has been formed. Okay, they are agent, they are liable for the firm, and at the same time the firm also has a binding on them. Okay. As a principal, they are bound, means the firm is bound by the act of the other partners, and as an agent they represent the other partners through their act. Okay. So when one of the partner will enter into some agreement with outside party, then he is like an agent of the partnership. Okay. The same way, if any of the partner is acting or having some agreement, then the remaining partners will be a principal for the act of that partner. So we say that there is a mutual agency, which is the partnership, and every partner is an agent as well as a principal, and the agreement here will be of sharing of profits. So there should be always profit motive behind forming of partnership, and once that profit has been earned, they have to decide, or there should be an agreement like how the profit must be shared among the partners. So when the partners, they enter into agreement, with that there are different rights for partner. Every partner has a right to participate in the management of the business. They also can be consulted about the affairs of the business. They have a right to inspect the books of accounts, and they can keep a copy of those book of accounts. Also, they have a right to share the profits and losses with others in the agreed ratio. So all this agreement which the partners make between them, if the agreement between the partners is in a written form, as I mentioned earlier, the agreement may be in written or oral form, but if this agreement is in written form, that written document, which is the agreement between the partners, is known as partnership deed. And partnership deed is a document which contains the terms and conditions of partnership. It will have some of the important mention about the details of the partnership, like what is the objective of the business, the name of the business, the address of the business, the nature of the business, the contribution of capital by each partner, in what ratio the profits and losses will be shared by the partners, at what whether the partner will be entitled to interest on their capital, interest on any loan provided by the partner, what remuneration will be paid to any of the partner if they are agreeing to contribute as a help or as a manager in handling the affairs of the partnership. And along with this, there will be many other details which will be constituted in the partnership deed. So it's a written document which contains the terms and conditions of partnership. Now, another important provision is that partnership deed is an important legal document that defines the relationship between the partners. So it is important to have a written partnership deed, because there may be some disputes between the partners. So when such disputes arises, then partnership deed is a medium to solve those disputes. If there is no proof of the reason behind the disputes of the partners, then it will be difficult to settle the dispute. So if there is a written document which is in the form of a partnership deed, it will be possible to settle the disputes between the partners. Also, through partnership deed, the rights, the duties and the liabilities of partners are well defined. So there will not be any confusion or any conflict between the partners relating to their rights, duties and their liabilities. So it's important in that sense. But what if in some cases, because it is not compulsory to have a partnership deed, so what if the partnership deed is absent? If partners, they do not have a written document in the form of a partnership deed, then what will govern their uh, accounting treatment of the various rights and what the partners are entitled to from the partnership firm? So there are some important points to discuss here. That is, if there is absence of partnership deed, then the following provisions of Indian Partnership Act 1932 will apply. This is very important. The first being profit sharing ratio. If there is no partnership deed, or if the partnership deed is silent, even if they have a partnership deed and they haven't specified what shall be the profit sharing ratio, then in such a case the profit and losses are to be shared equally by all the partners, irrespective of their capital contribution of the firm. In this case, because there is no mention of profit sharing ratio in the deed, or if they didn't write any partnership deed, then the profit will be shared, profit or loss will be shared equally by all the partners. Even though one partner has more capital contribution than the other, he cannot claim to have a bigger share in the profit. It will be distributed equally, whether it's profit or loss will be equally shared. The second point is relating to interest on capital. Again, if there is no partnership deed, then no partner will be entitled to any interest on the amount of capital contributed by them as a matter of their right. They cannot claim any interest on their capital. So there will be no interest on capital payable to the partner if the deed is silent. But in case the deed has mentioned that their partner must be paid interest on capital, but the rate of interest is not specified in the deed, then in such a case that partner who are entitled to interest on their capital as per the partnership deed will be given interest at the rate of 6% per annum. 6% per annum. But this interest will be only paid if the firm is earning a profit. If there is profit in the business. If the firm incurs losses, then no interest on capital will be paid to the partners on their capital. Then interest on drawings. If there is no mention of interest on drawings in the partnership deed, or if there is no partnership deed at all, then there will be no interest to be charged on the drawings made by the partners. The drawings means a part of their capital which the partner withdraw for personal use. So on those drawings, there will be no interest that will be charged on the drawings. Means the partners will not be debited for the interest on drawings. And interest on advances. Advances means the loan. If any partner has advanced some money to the firm beyond his capital contribution, that is in the form of a loan, then on that loan which he has advanced to the firm, that partner will be entitled to get an interest on the amount at the rate of 6% per annum. Again, if no partnership deed is there, then the interest on partner's loan will be given at the rate of 6% per annum. And the last point is regarding the remuneration of the firm's work. If any partner is doing some additional work as a helping hand for the partnership firm, then if there is no partnership deed, or if the partnership deed is silent about what the partner must be getting as a remuneration, then in that case no partner will be entitled to any salary or any remuneration for taking part in the conduct of business of the firm. Unless there is a mention in the partnership deed, a partner cannot claim to have any extra remuneration for his additional work done as a manager, or as a clerk, or as some help beyond his role as a partner. So they will not be entitled to any salary, any commission, or any form of other remuneration if there is no partnership deed. So I repeat all these points. In the absence of partnership deed, profit and losses will be shared equally among the partners. There will be no interest on capital paid on the capital contribution by the partner. If there is no partnership deed, no interest on capital will be charged. If any partner has advanced any loan, then on that advances, interest on such loan will be paid at the rate of 6% per annum. And if a partner has worked for additional role as in the conduct of the business, then on this he will not be paid any kind of remuneration in the form of salary or a commission or any other remuneration. Okay, so this is the rules to apply if partnership deed is silent or if there is no partnership deed. Now the amount which the partners contribute to the firm is termed as their capital. Okay. Now how the capital account of partners will be maintained in a partnership firm? Now there are two methods by which capital account of partners can be maintained. These methods are namely fixed capital method and fluctuating capital method. So we shall continue this discussion in our next video. The remaining topics from this chapter.